UK's Reeves unveils £26 billion tax rises and ends two-child benefit cap. US Treasury reports a $284 billion federal deficit for October. And Deutsche Bank raises its 2026 gold price forecast to $4,450 an ounce. The International Monetary Fund has warned that Germany's medium-term outlook remains weak, even as Chancellor Friedrich Merz argued the economy is beginning to turn a corner after his landmark fiscal reforms earlier this year. And according to the IMF forecasts, Germany is the only G7 economy that has not grown over the past 2 years, with only modest expansion of an 0.2% expected this year. The IMF also stressed that Germany's rising public spending must be paired with growth-supportive reforms to ensure sustainable recovery for Europe's largest economy. It further welcomed Berlin's easing of strict debt rules, which enabled greater public expenditure and paved the way for economic recovery. Economic Institute, the IW, has revealed that Germany remained the European Union's largest net contributor in 2024, despite its ongoing economic crisis, though its payments have fallen sharply from previous years. And data showed that Germany paid a 13.1 billion euros more into EU treasuries than it received last year. And France ranked second with net payments of 4.8 billion euros, followed by Italy at 1.6 billion euros. The figures also showed that Greece was the largest net recipient at 3.5 billion euros, ahead of Poland with 2.9 billion and Romania with 2.7 billion. On a per capita basis, German citizens paid around 157 euros net to the EU, the highest amount, followed by Ireland at 130 euros. And still in Europe, the British Finance Minister Rachel Reeves has announced £26 billion in tax increases aimed at shoring up the UK economy in what is being seen as a make-or-break budget for the government. And she outlined a high-value council tax surcharge from 2028 on properties over £2 million, introducing an annual charge of £2,500 to £7,500, expected to raise over £400 million by 2031. Reeves also introduced a 2,000 cap on salary sacrifice into pensions, effective 2029. Reeves also confirmed the removal of the two-child limit in welfare from April and announced a 4.8% increase to the basic and new state pensions, amounting to £440 and £575 per year, a move estimated to cost £3.1 billion by 2029 and 2030.
Is that a breach of your manifesto, Chancellor? How can voters trust a thing you say, Chancellor?
I said I would cut debt and borrowing, and I meant it. Because of this budget, borrowing will fall as a share of GDP in every year of this forecast. Our net financial debt will be lower at the end of the forecast than it is today, and I will more than double the headroom against our stability rule to £21.7 billion, meeting our stability rule and meeting it a year early. To break the cycle of austerity, we need a fair and a sustainable tax system, one that generates revenues to fund the public services that we all use and supports investment to grow our economy. That does mean that today I am asking everyone to make a contribution.
And for further analysis, we are joined from London by the member of the UK Conservative Party, Mr. Babak Emamian. Welcome to Qnews, sir. Sir, let me ask you first, how does the government plan to balance cutting tax and borrowing with the need to maintain funding for public services and investment?
Thank you for your question. Obviously, this is a budget of wealth distribution. So to answer your question, the government is taking money from the productive side of the society, the wealth makers, the ones who work hard, and redistributing it to the less productive side of the society. And by doing so, they are saying we are growing the economy. So it doesn't make sense. You take money from people who are most productive, who are wealth makers, and giving it to people who are less productive and are not wealth makers, and you expect the economy to grow. And there's also a moral issue here. Is this morally right to take money from people just like that? It is. They can do it legally. It's maybe legal theft, but really it is very immoral just to take money from some people and give it to others.
To other people, yeah. Sir, what are the expected economic impacts, do you think, of maintaining income tax and national insurance thresholds at current levels for an additional 3 years?
Almost impossible, because this time next year we will have the same problem. There will be a shortfall of 20, 30, maybe 50 billion pound in the budget. And that's because of the welfare system is all the time expanding. And it is now like consuming around 40% of the old taxes. So every pound of tax you pay, 40% of it goes to the welfare system. And it leaves very little for other important infrastructures in the country.
Could you explain to us what might be the rationale behind the reforms to the inheritance tax on agriculture and business assets, and how they address wealth inequality, do you think?
Well, there is no rationality side of it. As I mentioned, there is no morality to it either. By just some people have more wealth, you say, oh, we have the right to take your wealth away just because you have more money or more wealth, and giving it to others. So there is no rationality. The only reason they look which sector of society has more money, and they are targeting them. They are targeting now people who have properties over.
Actually, that's my next question, basically, which is how will the new high-value council tax surcharge on properties over £2 million affect the property market and the homeowners?
Well, let's say you own a property. You own a over £2 million property.
Yeah.
So you said that you don't have to pay the taxes immediately. So it'll be added. It will be paid on when you sell the property, or God forbid, when you die and give it to your next generation.
Yeah.
So let's take 2% of taxes on per property. So within 10 years, the government already owns 20% of your property. Mm-hmm. With 20 years, they already own 40% of your property. And if your property is not a residential property, it's a commercial property, you have to pay capital gain tax. So in 20 years' time, you pay 40% for this extra surcharge, plus 30% on capital gain tax.
And so, isn't there also the inheritance tax?
And similar with inheritance tax, because this is separate to inheritance tax. Okay. So you would have inheritance tax, and this is extra on top of that.
Mm-hmm. Yeah. Well, what is the significance of maybe capping the salary sacrifice into pensions at £2,000? And how do you think this will protect the low and middle income workers?
Well, let's go 100 years ago. 100 years ago, there was no welfare system. All taxes were collected, were either spent on defense of the country, defense of realm, defending the country, or on law and order. That's what it was. Since then, we started with free healthcare, free housing, free education, and people who were unemployed. It added. Right now, 40% of all the government revenue is spent on these welfare system. Now, it is fine. There is no issue, but there must be a limit, because you cannot just take away money from the wealth maker, giving it to the others, because what happens is eventually the wealth makers become weaker and weaker and weaker. As I described, even with this £2 million property, within 20 years, they hardly would own their own property. And what is to say that they won't apply the same thing next year to the businesses? So we are saying, socialism coming back into Britain.
And what are the aims and the potential challenges, do you think, of introducing an electric vehicle excise duty based on mileage, especially with the shift towards cleaner transport?
Well, we have a problem with our energy costs right now. So whether it's electrical or whatever, there is a problem in the United Kingdom because they don't have a proper energy policy. The cost of our energy is almost 4 times that of United States. So if you are a manufacturer, why would you be here when you have to pay 4 times more for your energy? And we know that the cost of energy, it accounts for 80% of inflation. So by just lowering the high cost of energy, you actually lower the energy. But then again, there is no policy for that. They're still pursuing the green policy, which all it does, it makes energy more expensive.
Mm-hmm. And how do the changes maybe in gambling duties, including the abolishing of the bingo duty, fit into the broader fiscal and social policy goals of the government?
Well, that is taxing entertainment, which I have no issue with it when you tax entertainment. Again, as long as you don't damage the entertainment industry, you do it reasonably. I am against any form of taxations on manufacturing, on the retail sector, on hospitality, on banking, and many others, the ones that wealth generate and are essential to our economy. But when it comes to, for example, gambling or so, I have no issue as long as it does not destroy that part of it, because a lot of people enjoy gambling.
And how does the Office for Budget Responsibilities forecast influence the government's commitment to reducing budget borrowing as a share of the GDP each year?
Thank you for that question. The best thing we could do is get rid of Office of Budget Responsibility, OBR, because they've done nothing but disrupt the decision making. If you go back previous to 15 years ago, there were Treasury and Bank of England who were responsible for the economy. Suddenly, we were given FCA, Financial Conduct Authority, to set the regulations, which is a form of taxation, and the OBR, who would tell the Chancellor or the Treasury how much money that you can spend. And every prediction they've given is wrong. It's a bunch of economists, which they get everything wrong because life changes, and none of them are from business backgrounds, so they can't anticipate what would happen. And yet they have been given so much power. So if we get rid of these 2 layers of government, the Financial Conduct Authority and the Office of Budget Responsibility, our economy will grow much faster.
Actually, that's my next question about the OBRs. And the government plans to more than double its headroom against the OBR stability rule a year early. What does this mean practically for fiscal discipline and economic resilience?
I wouldn't take it seriously. Again, I say the predictions they have been given, we just go back a couple of weeks ago, 6 weeks ago. First, they said there's a shortfall of 30 billion. Then they said, no, there will be a shortfall of 20 billion. Then they revised it. They said, no, it will be a shortfall between 20 to 30 billion. And I'm sure if you ask them today, they would come up with another figure. So what I'm saying is, and these people are all unaccountable. We don't know who they are. How they make the decisions. It's not disclosed to us how they make decisions, how they arrive at the decision. And why should we trust their predictions? Just because they have this brand name, OBR, backed by government, or FCA, Financial Conduct Authority, suddenly we can't even talk about them or touch them. Of course, I just want to add, the only person who's broken all these taboos is President Trump in America. He's broken all the taboos about central banks, about these institutions, and he's saying they have no clue, and every time he's been proven right.
Well, from London, that was the member of the UK Conservative Party, Mr. Babak Emamian. Thank you so much, sir, for your insights. And now we move to the latest developments from all over the world. And we have in Asia, the Bank of Thailand is launching a major crackdown on illicit money flows and expanding its supervision to include gold shops, currency exchange outlets, and e-wallet operators. Governor Vitai Ratanakorn announced the overall will close a critical regulatory gap that has prevented the central bank from directly monitoring suspicious transactions. New rules will require banks to report unusual activities, such as rapid, large fund movements, directly to the BOT rather than solely to the Anti-Money Laundering Office. The measures target grey market flows and link to online scams and gambling, with stricter know your customer rules and penalties for non-compliant institutions. And moving on to Latin America, the Brazilian Institute of Geography and Statistics has reported that annual inflation fell back within the central bank's target range in early November, marking the first time since mid-January that the consumer price index met the target band. And prices in Latin America's largest economy rose 4.50% in the 12 months through mid-November, down from a 4.94% a month earlier. In the month to mid-November alone, prices in Brazil rose 0.2%, ticking up from an 0.18% in the previous month. The IBGE noted that the monthly rise was driven by higher personal expenses, healthcare, and transport prices. It added that closely watched food and beverage prices edged up to an 0.09% after 5 months of declines, while household article costs fell. And in Africa, Senegal has released revised gross domestic product, resulting in improved debt metrics, a move the finance ministry has described as an attempt to give a more accurate picture of the economy as it grapples with a crisis over unreported debt. And according to the National Agency for Statistics and Demography, the updated 2021 GDP is 17,316 billion CFA francs, an increase of 13.5% from the earlier estimate. This revision lowers the public debt ratio for 2021 to 80%, down from a 90.8%. The report does not provide any updated figure for more recent debt levels. And in Oceania, the head of the International Department at the Reserve Bank of Australia, Penelope Smith, has stated that the country's financial conditions were influenced by global factors, with low equity risk premia and credit spreads suggesting conditions may be easier than otherwise. She noted that the cash rate is not the only influence on the cost of finance in Australia, but the extent of impact from international developments was highly uncertain. Smith added that the structure of the financial system, which is dominated by banks, could mean the developments in capital markets are less important for financial conditions than in other economies like the United States. And on a global note, Reuters has reported that German insurance group Allianz plans to cut up to 1,800 jobs in its travel insurance division, mainly in call centers, as artificial intelligence increasingly replaces manual processes. Between 1,500 and 1,800 jobs are set to be eliminated at the Allianz partners over the next 12 to 18 months. The U.S. Treasury has reported a $284 billion federal deficit for October, a figure inflated by record tariff revenues and the shift of about $105 billion in November benefit payments into last month due to the government shutdown. And it noted that without these timing shifts, the deficit would have been about $180 billion, 29% lower than a year earlier. Outlays rose 18% to a $689 billion, though shutdown delays trimmed spending by less than 5%. Receipts hit a record of $404 billion, up a 24%, boosted by a surge in non-withheld tax payments, particularly from California residents granted wildfire-related filing extensions. And U.S. President Donald Trump has said that the pressed Chinese President Xi Jinping to accelerate and increase Beijing's purchases of the U.S. goods during a phone call on Monday. And the Chinese leader had more or less agreed.
I spoke to President Xi about a lot of things, but trade and buying our farm products, and he said he agreed with me. I think he's going to very much surprise you on the upside. I asked him, I'd like you to buy it a little faster. I'd like you to buy more, and he's more or less agreed to do that. I think we will be pleasantly surprised by the actions of President Xi. I have a good relationship, great relationship with him. I like him, he likes me. I'm going to be going there in April. I guess you'll all be going with me, but I'm going to be going to China in April.
And the Chancellor of Austria, Christian Stocker, has announced that his country plans to spend around 500 million euros to reduce electricity bills using funds from state-owned company stakes. And the budget-neutral measure revealed upon Stocker's return from surgery raised questions about the funding source, which he declined to specify. And that comes as Austria holds stakes in firms including OMV, Verbund, Austrian Post, and A1 Telekom, with details to be finalized within the government. Information Minister Ashwini Vaishnaw announced that India has approved a 72.8 billion rupee program to manufacture rare earth permanent magnets and aiming to reduce reliance on imports for materials vital to sectors such as electric vehicles, aerospace, defense and renewable energy. The Heavy Industries Ministry stated that the initiative will boost self-reliance by supporting facilities with a combined annual capacity of 6,000 metric tons. This capacity will be allocated to 5 companies through a global competitive bidding process, with each eligible for up to 1,200 metric tons per year. And the UK government has announced that it will allow new oil and gas production on or near to existing fields with some conditions, reiterating that there were no plans to issue new licenses. It also stated that no changes to one of the world's heaviest tax regimes for the industry that includes a windfall tax of 38%, bringing the overall tax burden to a 78%. And the cost of hiring an oil supertanker hit a 5-year high as buyers turn away from sanctioned Russian crude amid rising supply from the Middle East and the U.S. Benchmark rates for very large crude carriers, the VLCCs, carrying up to 2 million barrels from the Middle East to China, reached nearly $137,000 a day, a 576% increase this year. A broader VLCC index also climbed to $116,400 a day. And the surge follows U.S. sanctions on Rosneft and Lukoil, boosting demand for alternative suppliers. Smaller tankers, including Suez-Max vessels and product tankers, switching to crude have also benefited from rising rates. And oil prices were steady on Wednesday after sliding to a one-month low in the previous session as investors assessed prospects of oversupply and talks over a Russia-Ukraine peace deal. Brent crude futures lost $62.35 a barrel, and the U.S. West Texas Intermediate crude futures were down a $57.8. Deutsche Bank has raised its 2026 gold price forecast to $4,450 an ounce from a $4,000, citing stabilizing investor flows and persistent central bank demand. And the bank now expects a $3,950 to a $4,950 range next year, with a top end about 14% above the current price of the December 2026 COMEX gold futures contract. The bank also projected that ETF flows would help maintain a price floor next year, saying they suggest a $3,900 per ounce support will hold. It also maintained its 2027 gold price forecast at a $5,150, saying it straddles the uncertainty between businesses as usual and elevated official demand scenarios. And gold prices hovered near an over 1 week high on Wednesday after expectations the U.S. Federal Reserve will trim interest rates next month kept non-yielding bullion a favored asset. Spot gold was up an 0.8% at a $4,161 per ounce after hitting its highest since November the 14th earlier in the session. And the U.S. gold futures for December delivery rose an 0.4% to a $4,158.80 per ounce. In markets, the European Central Bank has warned Eurozone lenders to bolster their capital and liquidity buffers amid the risk of a dollar squeeze that could strain funding markets. And it urged banks with the largest US dollar exposures, including BNP Paribas, Deutsche Bank, Banco Santander, Société Générale, Groupe PPCE, and ING and Crédit Agricole, to prepare for potential liquidity shocks that could hinder their ability to raise cash. The bank also warned that a squeeze in the dollar could impact these banks' ability to raise cash and warned them to prepare for this. And global markets have shown a collective gain across all indices during Wednesday's session. In the United States, the S&P 500 rose an 0.83%, the Dow Jones Industrial Average added an 0.76%, and the Nasdaq Composite jumped an 0.94%. In Europe, Germany's DAX increased an 0.98%, France's CAC 40 gained an 0.81%, and Britain's FTSE 100 climbed an 0.92%. And across Asia, the Hong Kong Hang Seng Index advanced an 0.13%, and Japan's Nikkei 225 surged an 1.85%, while China's Shanghai Composite tumbled an 0.15%. And that brings us to the end of our economic bulletin, and here's what we have been covering. UK's Reeves unveils £26 billion tax rises and ends two-child benefit cap. U.S. Treasury reports a $284 billion federal deficit for October. And Deutsche Bank raises its 2026 gold price forecast to $4,450 an ounce. And this concludes our economic bulletin. And don't forget to follow Qnews on YouTube, Facebook, X, Instagram, and TikTok at QNewsEG to stay informed. And thank you for watching, and stay tuned for more updates on Qnews.